Good morning, ladies and gents, and a hearty welcome to all of you to the second equity update by Prescient Investment Management. It's always a huge privilege for us to talk to our clients and potential clients, and today is no exception. Although we are all a bit bruised and battered with the equity markets, where we're down, depending on which market you operate in, between 10 and 30% year to date. It's not a comfortable place to be. We all hate uncertainty, but it reminds me of a quote I read from a guy called Morgan Housel in his book, The Psychology of Money. And he said basically to believe that the world is more uncertain today is similar to saying that the world was more predictable prior to COVID, wars, inflation, and all the other turmoils we've experienced. So as part of the equity market, there's ups and downs cycles. I think the important thing to focus on at this point in time is where to from here. We need equities in our portfolios to give us long-term growth, and we need to understand how we can construct diversified portfolios, blending different styles and processes to arrive at the optimal solution. And I know that the Prescient equity process is different from what most of our peers do. And we believe that our systematic evidence-based approach has huge potential with looking forward to the next year. We've seen bond yields spike tremendously. And it's an interesting topic to understand what yields has to do with the equity process at Prescient. And I trust that after today's session, you'll have a better insight into that. And you'll understand where our equity funds will fit into an overall equity portfolio for your clients. Just on the product side, briefly, we are very imminently launching our Global Emerging Markets Equity Fund in Dublin. It's managed in exactly the same process as our Global Developed Market Equities Fund that's we've been managing for around about 4 years already. And it sits in a suite of equity funds where we cover a number of benchmarks. So it's ideal to be used for alpha diversification in a greater portfolio of equity mandates. Just on the housekeeping side, this session will earn CPD points. You need to be logged in for the full duration. And once we get the confirmation from the FBI, certificates will be disseminated. So without further ado, I'm going to hand over to Seeiso Matlanyane, who's the head of our equities at Prescient, and Bastian Teichgreeber, who's Chief Investment Officer. And hopefully you'll find what they've got to say interesting. We'll talk a bit later when we deal with questions at the end. Thank you very much.
Yeah, thanks everybody also from our side for having us. Yeah, interesting times we're living through, I guess. Good intro. I couldn't agree more. Anyway, I guess, yeah, markets are always uncertain, and we are purposefully making this webinar very, very forward-looking. Because we want to highlight on what our view on the world is and where we think markets are going to go. So we're going to start by looking, as always, a little bit top down into the current themes, which we are thinking are definitive for global markets as we speak. We've taken you through quite a few of these in the past, speaking about COVID, the steepening yield curve in 2020, long gone, easy financial conditions, inflation still predominant themes, which we are having in dark blue here because we think they're still driving markets and featuring. We spoke to you about the Ukrainian crisis, the Fed's yield curve twist, which are both still quite important. Yeah, I guess strong global growth is the theme which we have faded a while ago. What we want to talk to you about today when it comes to macro, top down, and where the world and the equity markets are going is two new themes we want to speak into. We want to talk about macroeconomic themes, where we say we are heading the global storm. And then after that, we also want to speak about the high real rate environment which we are operating in. Okay, so there's two key themes. This is all about the beta of the equity market. So you will see why we are optimistic on SA equities, not so much US equities, but SA equities, strongly optimistic actually. But then we're also going to speak about our approach and why it's a perfect time for us to basically be investing into our equity process. So it's a good time for equities, SA equities going forward, but it's also a good time for the alpha generation of our core equity process. Okay, so I'm going to start with the theme Into a Global Storm. The name Into a Global Storm is derived from Jamie Dimon's quote. Jamie Dimon said, we are facing a hurricane, or he said economic hurricane is coming for us. And if from that derived, we think that there is economic challenges coming. We were not so pessimistic on global growth a while ago, but over the last couple of months, the numbers have changed dramatically. So the best way to look at it is our own in-house nowcasting. We use an indicator which we call the Prescient economic indicator, which is basically a summary of, or an aggregation of a lot of economic data. And what we're doing here is we're basically aggregating all the economic data which we can get our hands on, and we're running an econometric process to tell us where the economy is right now. So that's a much more promising approach than basically following just the GDP prints, because sorry, it's a much more promising approach than just looking at global GDP prints, because GDP prints are naturally lagged. Okay, so if you just bear with us, we just need to switch something off here.
Yeah, and do that. Do not disturb. There we go. And then we are back. There we go.
Thanks. Okay, so if we focus less so on South Africa, but more on the global market and looking at the red line, you can see that the business cycle is quite well predicted by our economic model. So you can see the great financial crisis in real time unfolding. You can see the COVID trouble here. You can see March, May, straight after the lockdowns, we catch the economic downtrend. And where we are now is basically we once again heading for a significant economic slowdown. Okay, economic slowdown, that's what we said a while ago, and we must now face effects. We are probably in for a recession, okay? If I look at this economic nowcasting, though, we must also differentiate. We are looking for a recession here. A recession might be around the corner, but the recession must not be mixed with the recessions which we had in 2020 after the COVID crash, or in 2009 after the great financial crisis. So we're heading for much less economic trouble. So that's a good news. So another way to look at it is another business cycle indicator. I'm going to switch wage growth off and just focus on the unemployment rate in the States. You can see the business cycle here quite well. So the unemployment rate never goes sideways. The unemployment rate comes down or it goes up. Okay, so it means that once we have a turn in the unemployment rate, this is a very lagged indicator, so one has to be realistic here. But once we see the unemployment rate going up, it becomes a self-enforcing circle, and we are in trouble, and we're heading for a significant economic downturn. Just want to show this chart because we're not there yet. Okay, we're not there yet. Okay, so what is a worry other than the economic slowdown? The big other worry which we are facing is inflation. So I want to touch on that as well. And as you know, 2 days ago, once again, 9.1% in the States, another all-time high, or not all-time high, but highest point since the oil crisis of the 70s. And that's obviously concerning. Okay, so obviously that high inflation print forces the Fed to react swifter, and it creates more worries. It also creates opportunities though. So if I want to dissect inflation a little bit, I'm not going to go too much detail for this webinar into this, but if we see what actually makes up these 9.1% inflation, I can see that a big chunk of that, once again, is new and used motor vehicles. A big chunk of it is motor fuel, which is linked to the oil price. A big chunk of it is linked to the food price. Okay, big chunk of it is even linked to restaurant prices. And there's other elements here, pure supply side driven elements, which will eventually fade. Okay, so I'm not understating the issue here, but we're not set for 9% inflation for the next years to come. It's exactly not what we should be expecting. If I scroll down a little bit more into this chart, I once again show that CPI inflation print here, 9.1%, but now I also compare it to break-even inflation. Right? We switch off inflation for a second and look into break-even inflation, the red line. Break-even inflation is the expected inflation, market expected inflation for the next 1 to 5 years. But it's just sitting at 2.7%. So the market is telling us inflation will come down aggressively during the course of this year. Okay, so if I'm put back inflation back on the break-even inflation and I get the gap between the two in the yellow lines, the yellow bars, you can see, yes, we are at kind of like an all-time high over the last 30 years in terms of CPI prints. But bear in mind, we are also at an all-time high in terms of how fast inflation is going to come down from these elevated levels. Okay, again, need to say it again, these high inflation prints are a massive problem for the market. And I do not want to understate anything here, but see the positives as well. It's not all terrible. Inflation is going to come down aggressively during the course of this year. Okay, so that's some positive on the macroeconomic front, but the good news is I've got more good news for you, and I guess it's necessary these days. We want to speak about high real rates, and this is now linking everything back mostly to South Africa. We're going to speak about 2 or 3 US charts in this section as well, but I want to start by looking, also focusing on SA. Okay, so what I actually want to get is, yes, we're looking at a significant economic slowdown, and yes, we're looking at exceptionally high inflation trends. So this is the whole story about stagflation, low economic growth, high inflation. I mentioned already before why this is not going to be the theme for the years to come. But the other point and the other angle is we have been priced for this already. Okay, so it's not that we are at the peak of a bull market and now we are facing the challenges. We have been priced for this. So if I look at the different asset classes on the y-axis here, you can see that basically all the major asset classes are significantly in the red. So they are down. And if you look at, Meyer mentioned it in the intro, you look at global equities, we're down more than 20%. We're down on SA equities quite significantly. We're down on SA bonds more than 4.5%. We're down basically on each and every asset class. So we, for a long time, didn't have a period where everything was that red. Okay, so we have had a significant amount of repricing playing out already. Okay, this is an equity seminar, so let's drill in on equities a little bit more. I'm not going to look into the individual indices, but I want to see the S&P 500 index semester returns on this chart. So basically just splitting the year in half, and you can see that the first half of 2022 was one of the worst first halves which we had. Okay, so it's a quite massive shock on the S&P 500, which we've lived through already. If I look at to the JSE All Share Index, we can see that 2022, the first half, again, one of the bigger shocks compared to the long-term history. Okay, we're not fans at all of looking at past price movements to predict future price movements. Markets could be down 20% for exactly the right reasons, and markets could be down from being down 20%. That has nothing to do with whether they can't be down another 20% if earnings collapse. But this is not where we are. So if we once again now focus on the forward PE ratio, even for the S&P 500, where we were speaking about all-time high valuations for so long now, we have moved back all the way to the long-term median. So we are actually on a forward PE ratio almost fairly priced. Okay, market is at least not that expensive anymore. And now again, this is an equity seminar. We want to focus on SA, so I want to bring it back home again and speak about the all share index again and the forward PE ratio of this index. You can see that we are in the bottom decile, and this is on the forward PE ratio. So the market is cheap. It's very, very cheap. So it's very, very attractive from a pure valuation point of view. And we must face it. It's a lot of bad news is already in the price. We think there's a recession, a shallow recession coming, yes, but it's already in the price. And it's not going to be as deep as 2008 or 2020. We expect inflation. We are aware of a 9.1% inflation print, but we expect inflation to come down. Don't want to sound complacent. There's macroeconomic challenges all over, but we have repriced already, and there is reasons why we expect these macroeconomic challenges to eventually abate. Okay, so let me take one step into our SA equity view directly, because it's not all about valuation. So as you know, at Prescient, we do not just look at value factors, we look at a whole slew of economic valuation, sentiment, and financial conditions indicators. And yeah, our equity remains strong overweight, and you can see our valuations through time. We've been in the strong overweight since the beginning of this bull market, so it has helped us. But now let's look into these 4 pillars: valuations, economics, financial conditions, and sentiment. The red indicators are the negative contributors, the blue indicators are the positive ones. Everything on the valuation front is clearly positive. If I look into the economic front into SA, we can't really see that sharp drawdown economic setback for us. We've got a very different economy benefiting from higher commodity prices. We've got very elevated profit margins. In the global space, we still have a strong labor market. Monetary policy for now, if I look at it in real terms, does remain easy. There's no funding pressure on the big banks. Investor sentiment, we see it as positive because investor sentiment already is very negative. The fear in the market is already excessive. So we have that already featuring. There's zero complacency. Sentiment is terrible, which is a good indicator, a positive indicator. So a lot of reasons from a beta point of view to be positive on SA equities, and we have a quite firm positive stance on equities, SA equities, but we need to now link, and that's where I'm going to hand over to Seeiso. We need to link that to our equity process. And before I do that, I actually want to go back to one last chart and back to the high real rates where I spoke about the attractive valuations for the SA equity market. Valuations in South Africa are also attractive, not just in the equity space, which I've shown you, but also in the fixed income space. Okay, so I just want to show you one last chart, and this is now moving a little bit into the fixed income world, which we have to do when we speak about our alpha generation. We're showing the 1 year NCD. So this is basically a 1 year rate which you earn if you put your money down for 1 year. And this is a big 4 bank, senior, very limited credit risk. And then we compare that against 3 months JABA. Why is 3 months JABA relevant? Because 3 months JABA is where we are funding our exposure for our portable alpha process. Okay, so if I take the spread between those two, this is exactly the pickup which we can earn easily without taking a lot of credit risk. Okay, you can't take a lot of credit risk. So if we do that and just plot that, you can see that the expected pickup for our portable alpha strategy is literally higher than it has ever been. And this is obviously a function of the very, very steep yield curve, which we are seeing in SA. I mentioned the inflation dynamics. We know inflation is going to come down, but inflation is at 9%. So we need to push through aggressive hikes in the States, but we need to push them through quickly because we have this window of opportunity now where rates are high, where inflation is high and inflation expectations are low. So inflation is going to come down. So we want to hike, but we want to hike now. And that leads to a very steep yield curve at the front end. You know, the 10-year, 2-year spread is almost inverted in the States, but the front end is very steep. The front end is what matters for our portable alpha process. So extremely attractive environment from a beta point of view, extremely attractive environment from an alpha point of view. And I guess that's a good opportunity to speak about the alpha.
Yeah, exactly. Thanks, Basti, and thanks, Maya, for the intros. So yeah, I always have to find myself having to sort of take a step back and remember that we're talking about equities, and therefore link everything together as to why we're talking about why the steepness of the yield curve in the front end is such an important indicator and a good source of alpha for our products. And it's all because of the way we actually run the products. So I always show this picture, showed it in the last webinar as well, and I think it's worth taking a step back to remember how exactly we run our process and why fixed income is such a big portion of our total realized return. So we have this alpha and beta separation process, simply stated portable alpha, whereby we gain synthetic market exposure through a derivative, and that's how we get our beta. So when we think about whether markets, equity markets are going to go up, whether they're looking cheap or expensive, we simply take market exposure using synthetic instruments instead of stock picking, and that's the beta component taken care of. And then the alpha component comes very much from our fixed income process. So we generate alpha. Having synthetic exposure to the market allows us to invest the bulk of the cash in fixed income instruments, obviously all within regulation and within sort of risk tolerances, but it is precisely the fixed income component that generates the outperformance over the market exposure. So us talking about the fixed income dynamics and the top-down macro view and our views on inflation and where we think rates are going to go translates directly into the alpha that we can generate on top of the beta exposure. So Bastian mentioned the front end of the yield curve is currently extremely steep. I'll go a little bit deeper into that and just show you the progression over the last 2 years and exactly how steep it is right now. So if I just switch all of this off and start with 2 years ago. So 2 years ago, you can see that the FRA curve was sort of pricing in around 3.7% from in 12 months from 3 years ago. So if you take that forward to how it looked 6 months ago, you can see this incredible steepening in the front end. 3 months ago is even better, and as we're standing here today, it's about as steep as we've seen. So currently, the market, if we look here at the 12-month point, the FRA curve is pricing in around 8.13% in repo in 12 months, and repo is currently sitting at around 4.75%. So what this means is that the market is expecting that rates are going to be at 8.1 when currently we're sitting at around 4.75. This is a huge amount of premium that is priced in simply for taking a bit of term. So how does this translate into our view? So we simply do not see it plausible that the short-term rates are going to be that high within a 12-month space. When it comes to our allocation of our fixed income components on the back of our synthetic beta exposure or market exposure, we have the decision to make between whether we prefer fixed rate instruments or floating rate instruments. And to sort of delineate that decision making and sort of have a look at what the risks are and how much rates need to rise before we start actually losing money, we do a simple scenario analysis, and I'll just go through that again, just quickly step by step. So what we have here is just the call rate. Currently, what are we earning on cash that's just put in a call account under the different scenarios? And importantly, these are the most prudent scenarios in the sense that we're assuming a flat rates between now and 12 months. Here we're assuming 25 BIP hike today. So this is what you would earn on call if the MPC came out and hiked rates by 25 bips today, what you would earn over the next 12 months. And if we put on the fixed rate instruments, so the current 1-year NCD is earning around 7.5, so that's a fixed rate. Whether the SARB hikes today by 25, 50, 75 bips, etc. If you lock in, if you buy a 1-year NCD at 7.5, you're locking in that rate, which is significantly higher than sort of the call rate. And importantly, if we then add on what you would earn in a floating rate instrument, so just a 1-year floating rate instrument, and assuming that the SARB goes ahead and hikes rates tomorrow by each of these magnitudes, where is the turning point? And hence this informs our decision and our preference towards fixed rate instruments as opposed to floating rate instruments. So this shows quite simplistically that unless the MPC tomorrow hikes rates by 150 basis points, it pays significantly more to be in fixed rate instruments. Hence, that steepness of the front end of yield curve is such that you have to, or we prefer to be in fixed rate instruments, take that term risk, because the market is pricing in such aggressive rate hikes that the floating rate instruments simply would not be able to yield that much, even if they were hiked aggressively tomorrow. And of course, this translates directly into our alpha, right? So beta component is taken care of, but taking fixed rate instrument pays incredibly well at this moment. And this is a similar chart to what Bastian sort of touched on. And what it shows is the difference between a 1-year fixed rate NCD versus 3-month JIBAR. Why 3-month JIBAR? Because our funding costs on the back of our portable alpha is linked to 3-month JIBAR. And basically the difference, so I'm just going to build it up again slowly. So this is 3-month JIBAR, and you can see it was hovering at around the sort of 6 to 7% range until COVID happened, when we saw rates getting cut down aggressively, and now we're seeing this sort of normalization in rates. And if you look at the 1-year NCD, there's been such a big diversion, i.e. there's been such a big premium to taking on a fixed rate instrument with a bit of term in it. So it's been so much above 3-month JIBAR that the spread is wider than it's ever been. So the spread is this gray area here at the bottom, which shows essentially what we expect to earn by taking on a 1-year NCD versus what we're funding at, which is linked to 3-month JIBAR. Importantly in the spread is that not only is it as wide as it's ever been, meaning that our forward expectations from an alpha perspective are as good as they've ever been, it's important to highlight the sort of progression towards this high point. So unfortunately, with these sort of fixed rate instruments, is that they have this mark-to-market effect, whereby if you had sort of locked in a spread a little bit earlier, you are going to suffer a short-term sort of like a J-curve impact on your relative performance as the spread ticks up. But that's a double-edged sword. On the one hand, you sort of have this negative mark-to-market because rates keep ticking higher and higher. But on the other side, your forward rates, the yield that you earn or you stand to earn over the next 12 months is incredibly high. And as you can see here, from an alpha perspective, we're looking at yields that are in excess of about 2%. So not only are you getting a sort of clean market exposure via whatever index that that you would want, i.e. Aussie, capped Aussie, Swiss index, you are looking to stand to gain over 2% in additional pickup from the fixed income component, just from the way that the front end of the curve looks right now. And yeah, and obviously we offer this product across a range of indices, not just locally, but offshore as well. And then importantly, we've also done some work where we have taken a sample of the general equity category, and we can use a simple tracking solution, apply this strategy on top of that to generate this pickup on top of what the general peers are doing. So quite compelling argument from a beta perspective, and a quite compelling argument from a fixed income perspective. And yeah, I think it's sort of given what the market has been doing lately. It's sort of the quote that comes to my mind is there's obviously a lot of fear priced into the market, but we know that equities deliver that long-term real returns. And as Warren Buffett said, this is the time to sort of be greedy when everyone is fearful. And given that all of the bad news seemingly is in the price and some, it makes sense not just from a beta perspective, but also from an alpha perspective to consider a strategy such as this one.
So we're looking at extremely attractive beta opportunities. We gave that in the intro in the macroeconomic environment. We think that there's challenges, but the market is priced for it is cheap at these levels, and there's a lot of upside in it. At the same point in time, Seeiso highlighted why it's particularly attractive for our alpha engine right now, the environment which we are operating in. So where's the problem? And I think the problem is generally when investing in equities in South Africa, that we have this massive dispersion between funds against their benchmarks, but also against the general equity category. And there's two reasons for that. The first of all is a lot of the funds are running massive tracking errors. So there's nothing more frustrating than being long equities, but then you pick an underperforming fund because the fund manager decided to go defensive. As Seeiso said, that cannot happen to us because you get clean market exposure through our strategy. At the same point in time, another reason why there's a lot of dispersion is because the managers in SA, which are in the general equity category, choose different benchmarks. So some of them follow the capped Swix, some of them follow the full ALSI. It's different. So what we've done, and that's what Seeiso alluded to, is through a random portfolios exercise, which we run every day. It's actually quite possible to create 1 million portfolios every day, random portfolios, and then we basically go down the curve, measure that tracking error, and check which are the guys with the lowest tracking error against the general equity category. So trying to say we know exactly what index exposure you need to basically replicate the general equity category. And that's a powerful tool to have. Why is it so powerful? Because we now know what to do to beat this market. So we have the super reliable alpha engine where we know that we can get pickup, which is superior to a pure passive. But we know now also which indices we need to put together to basically beat the general equity category. So I just want to say, on our side, we are basically running products on all of these individual indices in SA Swix, all the caps, all the caps Swix. You choose. So if you want any of these indices, we can run our process, and we do have unit trusts for all of these indices. Having said that, we also have a unit trust for the global equity market, so where we do the same process on the MSCI World, and then we are launching an EM version. Okay, so to conclude here, we know what the general equity category is doing. We know how to beat it, but we are able to constrain our tracking error. We're looking in an environment of very attractive beta, very attractive pricing in the market. But at the same point in time, we're also looking at an environment which is particularly attractive for our alpha engine. So yeah, back to the intro, into the storm. We have a hurricane coming our way. We acknowledge the challenges, we acknowledge the high inflation prints and the economic downturn which we are facing, but we do think it's a good time to be in equities, and it's a good time to be in the solution. So yeah, that takes us to the end of our presentation. I guess if there are any questions, it's a good time to ask. Yeah, thank you.
Thanks, gents. Yeah, I've got a few questions here. I do detect a sense of optimism in your voices. I gather that's from alpha expectations and not from beta expectations. As we do know that we've had a torrid time, and history has shown that the markets do recover. So let's just hope that that will happen at some point in time. The first question, though, is around the ability to optimize and synthesize the unit trust sector and general skill there. So do you guys have any optimization on what the outcome of the Wales box test is going to be tomorrow? Because I think at this point in time, that's quite pertinent.
Yeah, jeepers, hey, if we had that sort of optimizer at hand, that sort of crystal ball, I think I'd own a galaxy somewhere.
Okay, now seriously, look, obviously someone has been following the webinar, because they refer to the fact that we gain beta exposure efficiently through derivatives, and then we use the spread between the funding cost and the cover asset yield to generate alpha, and that's obviously much more predictable for future alpha expectations, considering that part of our core skills lies in yield generation and interest-bearing side. Now, if, as you explained, the term premium that is embedded in the longer dated instruments you increase your alpha. To what extent can you increase that term to increase your alpha expectations, and what guides that specific kind of level to where we can try and position the cover asset portfolio?
Okay, yeah, awesome. I'll take that one. So yeah, obviously, the main driver of that sort of alpha engine is term. The other is credit, but at the moment we're not taking any credit risk within the portfolios, mainly sort of government and sort of bank credit. But on the term side, with the spreads as wide as they are, or the front end as steep as it is, we obviously want to max out on that premium. But we are limited, given that we want the main driver of returns in these portfolios, even though we're talking about sort of fixed income most of the time. The main driver on these portfolios, the main volatility contributor, should always be the equity market. So we have very strict tracking error targets that we monitor, and we even though we're increasing term, we are very cognizant of the variation to our tracking error that could be caused by the mark to market on our sort of 1-year fixed interest instruments. So tracking error is a big thing, but importantly as well is we work within a regulatory framework, right? So there are very clear guidelines as to how far how far out we can buy these fixed interest money market type instruments. So the regulations are quite clear that it has to be money market type instruments, and we have to stay within a sort of a 13-month term to maturity. And our tracking error target on the high side, on the upper end, we look to limit that over a rolling 1-year period to less than 1%. So very tight on the tracking, because we want the equity market to ultimately drive the bulk of the performance in this product, and therefore we manage our cover or our sort of fixed income instruments to not add to the tracking error in such a way that it blows out beyond 1% on a rolling 1-year basis.
Okay, cool. Yeah, I mean, just to maybe put that slightly differently, is the cover assets are managed under constraints of Chapter 2 of Board Notice 90, which is the chapter that applies to money market funds. So if you know, money market fund price remains constant at 100 cents, so you can take very little risk in managing those cover assets in terms of what you're allowed to do. So one should not see it as being able to extend term or credit. You're not allowed to hold any credit-linked notes, for example, in the cover assets. So it is a pretty secure way of managing that cover assets and trying to generate alpha. So one should not see that as a risky strategy. Definitely less risky than, for example, a aggressive stock pick portfolio. Okay, on that note, the second question is around, we sit now with, on the one hand, the cover asset yield, on the other hand, the funding cost. And as we stand now, looking forward over a year, that gap is 2.5%. You showed what happens to the funding cost with increases in the forward yield on cover assets. I mean, do these two move in lockstep, or do we see opportunities where this gap, or certain circumstances where this gap increase or decrease?
Yeah. That's also a good one to clear up. So yes, we do have the component of the fund that is subjected to funding costs, via the derivative instruments that we use to gain that broad market exposure. And the drivers of the funding cost of those derivatives are, we find, quite different to what's driving the increases in the front end of the yield curve. So for instance, we've actually seen, even though rate expectations are increasing or have been increasing, the funding costs, and I'm talking particularly the spread that is charged over and above the risk-free rates, is actually decreasing. So that is a function of the availability of funding by our counterparties, which are just the banks that issue us the derivative instruments. It's a function of how easily they can get funding from treasuries or other sources. And the instruments themselves, the second point is that the instruments themselves are linked to a floating rate, which is mainly 3-month JIBOR. So yes, as 3-month JIBOR ticks up, obviously our funding spreads will our funding costs will tick up with 3-month JIBOR, but so do our cover assets, and importantly, the spread over and above that 3-month JIBOR we've actually seen coming down significantly. It typically is quite cyclical, and we've seen it sort of spike towards more the end of the year when there's a bit of a cash crunch and there's a lot of demand for liquidity in the markets, and when there's a lot of sort of dividend expectations, and I think sort of banks have to get their books in order for sort of year-end redemptions or what have you. So it's a very different driver, and I'm talking specifically just about the spread over 3-month JIBOR.
Okay, listen then, so we've now got the alpha expectation going forward. I suppose this question, trying to reword it slightly, is what are our kind of ideal versus worst case scenario going forward? In other words, what needs to happen for us to realize this expected alpha over the next 12 months?
Yeah, that's also a really good one. I think, given that the spread itself is as high as we've ever been, as we saw in the previous slides, if spreads sort of stay where they are, then we will earn that pickup. I think the difference is that if spreads continue to tick up, like I said, it's a bit of a double-edged sword, and that will experience an immediate sort of negative mark-to-market. But we saw with the scenario analysis, given our fixed rate positioning, we would expect to see a very, very aggressive increase in rates for us to actually start losing money. But we will see that sort of negative mark-to-market. But the other side of the sword is that we therefore stand in a much better position because we're sitting at even higher spreads to be earned going forward.
Subsequently.
So I guess another point to put it is not the answer is actually nothing. So if nothing happens, we are printing exactly the numbers which we've shown. If nothing happens, so it's we don't even have to market the yields to come back down or less hikes come through than priced for. If nothing happens, we're looking very strong. So
okay, maybe if I can just clarify something that Seeiso said quickly. You mentioned that if that spread would decrease, it's a long way before we start losing money. That's in alpha terms. Just remind the audience as well. Beta is going to do what it does. So if the market recovers, we're talking to alpha. So we can't go any other direction than the market. It's just the little variance around that.
Yes, correct. Thanks, Meya. It's a very important distinction to make. We're talking about losing relative performance, not absolute performance. Correct.
Listen, then just maybe we need to start wrapping up. The last one here, if you look at the dispersion of all the general equity funds, they are charted on the screen currently. I mean, we run a number of equity strategies in the local market, depending on which benchmark you choose, being the ALSI 40, ALSI 40 in the large cap sector, All Share Index, SWIX and Cap SWIX. Where on that graph do we sit? You've taken it off now again, Bastian. That one,
yeah. So with the blended solution, right? So what Basti mentioned, where we said we now have a way of finding the optimal combination of benchmarks that we can manage efficiently. And as a side note, you know, the reason we sort of prefer this portable alpha approach or the synthetic replication approach is twofold. One, that we can employ this portable alpha and put the money on fixed income, but importantly, the second one being that we can manage it at a much lower fee. So we've got a process that can strip out without looking at any peer fact sheets or anything like that, and come up with an ideal holding, and then attribute that to the specific indices, which is what Basti was going to here. Attribute that to the specific indices which we offer, and if we combine our funds in this fashion, and this is dynamic, so we have it throughout time. Oh, sorry, there we go. We have, just bear with me, we have it through time. So if we dynamically combine our various funds which are benchmarked to each of these indices dynamically through time, and the current allocation is like this, then we have a very strong performance. This is before portable alpha and after portable alpha, but we can just look at it before portable alpha, and the attribution to us doing much better than the average here is simply because we run it at much lower fees and much you know, a much more efficient way. But you can see it is relative. This is not relative to any of the indices. This is relative to the average of all those dispersed funds.
The general equity sector.
Correct. We can show it after portable alpha as well, which is obviously higher, given that portable alpha has been value adding. But I think this is this sounds like the question that was
okay, but so where, getting back to that dispersion graph, where would it sit?
So we would sit in to this extent above, sorry, we would sit to this extent above the average of those first.
Okay, so just go back to the graph.
Yeah,
to dispersion.
We just don't have it, and I think I don't necessarily want to go into any of these because it will start showing sort of
somewhere around there.
Stuff. Exactly. Yeah.
Okay. You can't show names there now.
But what we can do is we for the next webinar, perhaps we can highlight exactly where our product would.
Yeah, I think that's a good idea. So let's come back. Let's revisit this topic, because I think it's a great development on the statistical side, is to effectively mimic the general equity sector average and then add portable alpha. In any case, guys, I think thanks very much. I think that's all we've got time for. Thanks for your time, everybody that dialed in. Thanks very much for your time. We hope you have a wonderful weekend. Hold thumbs for tomorrow's test. We'll let you know what our simulation results are and whether we match that or not as a test on our accuracy. And let's just remember, as one always says in adventure bike riding, and markets are turmoil, stand up, look up, and open up. And let's hope that the clouds will disperse and we'll see blue skies again. And when you do, remember you've got a great equity proposition in Prescient to complement your portfolio and give you that efficient beta and constructed alpha in that. So with no further ado, have a great weekend and thanks for joining. Goodbye.
Thank you.
Thank you, everyone.
Thank you. Bye.